Hello, Marc Ostwald from ADM Investor Services International with some thoughts on the not so great news that we've had this week in terms of the coronavirus spread, how the dollar's performing, what the key factors are there, and also a little bit about the latest decisions that the Federal Reserve has made in terms of its open market operations. So my first chart is the US dollar index, and as we can see, it's been doing very well, particularly this year. It's recovered quite well from an end-of-year drop, which was predicated on the principle that basically the world was going into a better place because of the US-China trade deal. Obviously, things have changed in the meantime. But I think there's a general point which people need to remember about the performance of the dollar, and it relates to global trade. So both the coronavirus spread and indeed the US-China trade deal and broadly China trade tensions are relevant to this. Basically, the environment is such that if global trade is contracting as it is at the moment, that's a dollar positive because there isn't a lot of surplus dollars being generated via trade. Vice versa, when global trade is growing particularly strongly, then you'll see actually the dollar start to underperform as the excess trade dollars go into FX reserves and are diversified. So, how is this actually all impacting in terms of the world's real economy, in terms of the coronavirus spread, and what have we seen in terms of benefits from the US-China trade deal? So my first chart today is the combined traffic at the ports of Los Angeles and Long Beach, i.e. the ones which operate across the Pacific. It's the total loads, both exports and imports, and as we can see, it really does highlight just how much we saw much of a contraction we've seen since mid-2018 because of the trade tensions in traffic, and how there was a little bit of a blip up in January, but that will probably start to deteriorate, and we should be perhaps looking at that low that we saw back in January 2009 if the shutdown of the Chinese economy proves to be more protracted. The next chart in this is also showing on the other side of the Pacific the daily discharge rates of cargoes in China for crude oil, iron ore and coal. It's basically telling us, at what point are they actually going to be, because they've already got so much in storage, basically going to have to wind back on their imports of these key materials, and therefore imparts a negative demand profile there. So as one can see, basically, there has been a drop above all in terms of crude. One would have to say, in terms of the crude profile, it's important to understand that that doesn't necessarily mean that they're going to be dumping crude on the oil markets, because they would have bought it a lot higher a couple of months ago when they placed the orders. But it does mean that their demand for crude as we go forward, until such time as they recover, and this will be something of a J-curve, i.e. we've got over the worst of the coronavirus, will be that much lower, particularly as we go into the driving season. Therefore, buying oil on the back of the driving season is probably not a great idea. My fourth chart is also highlighting how that prospective lack of demand for crude is impacting on shipping rates to China for VLCCs, or very large supertanker type ships. We are hoping to see some sort of improvement, but I do wonder whether that last uptick was based on the coronavirus spread being past its worst, and now we're probably going to see that tipping back. My fifth and final chart for today relates to US bank reserve balances at the Fed. As we know, and you can see very, very clearly on that chart, the US S&P 500 has taken, the repo market and the S&P 500 has seen adverse moments when we see these bank reserve balances at the Fed contract, and when we've seen them build up, as we have since the repo debacle at the end of September. So it proves to be a great boost. Now that the Fed's winding back on its open market operations, my key question is going to be, what impact will that have on the reserve balances that the banks hold at the Fed, and how will that impact equity markets? Those are the thoughts for this week.